Welcome, everybody. Excited for Friday and excited to be back after having to take last week off. I apologize for having to cancel that last week's session at the last minute. Um what can I say? If you're not feeling like like you can afford to be more than a couple of steps away from the bathroom, then that probably says everything you need to know. Um, all right, let's. Hopefully, we'll get a few more people coming in as we get things rolling. This is we are off and running. The market's open, and so we have a lot to talk about and plenty of information in the markets to go over. But thank you, Gib. He's first in the chat stream, so that's awesome. Um, Excited to have you here and to be able to talk about what's happening in the market right now. Uh, so for those of you, if you're on here live for the first time, or possibly checking out this live stream for the first time after the fact, the purpose for this live stream is to look at the market through the lens of the Rebel Income system. Now, Rebel Income is a kind of a contrarian value-based investing system that focuses on income generation using the options market, where most people tend to think about options strictly in buying terms. If I think the stock is going to go up, I'm going to buy a call option. If I think the stock is going to go down, I'm going to buy a put option. We flip the script. Instead of being buyers, we like to be sellers. So uh, we use put selling specifically as an opportunity not only to generate income on stocks that we like with a strong value proposition and very healthy fundamentals. These are all dividend-paying stocks as well. We use those put options as an opportunity to set up a potential purchase of those companies. So the idea is that the strike price of the put option that we sell serves as a excuse me, as an attractive buying price. So the term I like to use and that I refer to quite a bit is that put selling is a gateway to owning the stock, to building my portfolio. Once you own a stock, then you have an opportunity to hopefully see it go up. Again, in the vein of income generation, the idea is to look for opportunities to generate additional income, not only through the dividends that the stock generates, but also by selling covered calls. If you can sell a covered call above the price that you bought the stock at, obviously, you have an opportunity to hopefully bake in a little bit of capital gains if you get called out of that covered call trade. If not, you have kind of generated your own dividend on the stock with an opportunity to keep doing it. And so that's kind of the lens of the kinds of trades that I focus on and that I send trading alerts out to in the Rebel Income community. And so the stocks that we look at today are going to be some of the stocks that I have highlighted over the last month or so that represent currently open trades. Probably have some opportunities to look at some of the stocks that some of the rest of you that are on the live stream are interested in as well. The idea here is to apply current market conditions and take a look at those and discuss them through the lens of a practical trade that we are trying to manage. So this is not only about generating income, but also understanding how to try to work with those trades while the market is moving, and how different market movements may impact opportunities to work with those trades, maybe to manage them a little bit more actively, or possibly to try to limit risk if necessary. So we'll take a look at what some of those opportunities are as we get things rolling. Okay, that's kind of the preamble, I guess. So let's go ahead and dive straight into it. It is September 19th, and that means that, as always, it's Expiration Friday. And so we actually have 3 different trades on deck, just in terms of the things that I've been tracking that are set for expiry today. Excuse me. Just to go back in time just a little bit since we skipped last week. There was only one trade on deck last week that was set for expiry on the 12th, and that was a put sale on CTRA. That was a trade that expired worthless, which for some people is kind of an ideal result with a put selling trade. Means that the capital that you've put on reserve to set up that trade it becomes available again for another trade, for whether you're working with the same stock or whether you decide to move on to something else. In my case, and the reason that I'm bringing this up is that when this option expired worthless, that meant that since I sold the $23 strike price and I sold I had two contracts, I had a $4,600 capital reserve requirement that I had to meet for the duration of that trade, either in terms of cash, available cash in my account, which would make it a cash secured trade, or a combination of cash and margin. I try to work on a cash secured basis as much as possible, just simply because that is a more conservative approach than trying to deal with the logistics and the potential complications of margin and margin interest and all of the rest of it. But a lot of the people in our group are placing these trades on margin, and that's fine too. The total requirement is the same though, $4,600 in this case. It's based on the strike price you're selling plus the number of contracts. Once that trade expired, then that meant that $4,600 had to go through normal trade settlement, which in case of the broker that I use, which is TD Ameritrade, that's usually about 1 to 2 days. Not in terms of calendars, but thank you, Barry. Not in terms of calendar days, but in terms of trading days. So when the market is open, typically Monday through Friday. That means that $4,600 didn't become available to trade until about Tuesday of this week. And that's one of the reasons that, in all honesty, the trading alerts I send out are on Tuesdays, and then I place the trade on Wednesdays. Doesn't mean I'm going to use the same capital every time. I try to keep enough dry powder in the account so that I can place a trade at all times. But in this case, it did free up that money, and then I was able to place a new put sale this week, just kind of riding the rented mule, as it were. Just put the stock right back in the trading rotation by selling the $24 strike price. If we have time, we'll take a look at that one again, but that one's not due to expire for about a month. So that'll be an interesting trade to keep track of. Market is moving, and obviously the Fed's decision earlier this week to lower interest rates is having a positive net effect on the market right now. We can see that the S&P 500 is starting to lift a little bit. We had, let me pull up my drawing tools. We had kind of a little bit of consolidation right up here at the top of the market's range through a good part of August. But since then, sorry, I need my tool again. There we are. But since then, it started to accelerate. And I think that if we want to talk about forecasts, the market finally got what it's been waiting for quite a while, which is an interest rate cut from the Fed, and that is giving investors a reason to be a little bit more optimistic. All right, Barry is in CTRA with the 2450 strike, expires 10/3, and brought in 63 cents. Barry you got me beat all over the place. The trade I placed expires on the 17th of October. I brought in 55 cents with a $24 strike price for CTRA. So, and it's breaking down a little bit right now. Just we'll see how this goes. But this is one of the stocks that is not benefiting so much from this current bullish momentum, and is actually a little bit below $24 as of now. So we'll see what happens with it. It's down at the lower end of its trading range for the past year, and that could be a good thing. Even again, remember when we're talking about a put sale, we're talking about. And I just realized I flipped the script. I said we were going to maybe come back to CTRA later, and here we are starting with it. But this is a really, really good example of kind of looking at what's happening in the market midstream in real time. And with the stock down here, in the lower end of its historical range over the past year, this is a really, really good company. And do a lot of work with uh, excuse me, LNG products, liquefied natural gas, and they have a really, really solid fundamental profile. Value proposition is really, really attractive on this one, and so I've used CTRA on a number of other trades in the past, and sometimes owned the stock. It's always been useful and has produced some good trades. We should see some pretty solid support, probably between 2350 and I would say about around these most recent pivot lows, possibly around 23. That does mean that there's a very good chance that I could be assigned here. We'll see if this momentum accelerates, if it stabilizes, or possibly even starts to go back up a little bit. Really hard to say right now. It does look like bearish momentum is increasing right now. If we just look at the last 3 days, seeing a pretty strong downtick in movement there. So we'll see where and if it stabilizes. But this is a company. If I get assigned at 24, that's actually not something that that bothers me at all. In fact, that would be a net positive thing for my account in the long run. And that's true even if I have to watch the stock sit below that price right now. Okay. So that's the trade that we placed that I highlighted this week. So yeah, Barry, when you're in it, the dividend yield is useful, and that's absolutely true. CTRA pays a little bit of a variable dividend, so it's not that they don't pay a consistent dividend. It's just that the amount can vary from one quarter to the next. So there's 22 cents, 22. I might be thinking about the wrong stock. Talking about the variability. I think I am. I think that may have been a different, maybe Suncor rather than CTRA. I apologize. But yeah, this is translating to an annual yield right now of 3.61%, and that is useful on an annualized basis. So it's maybe not as high as what you may be able to get on longer term yield instruments right now. But then again, with interest rates starting to come down, we'll see how long that is true. In any event, 3.61% is more than enough to be practical. Okay, let's start talking about the stocks that we have on deck for this week. We'll start with Comcast. This is a trade that I placed in the last week of August. So this has been about a 3-week trade, selling the 33.50 strike price and bringing in just a little bit under 2%, I should say, for that time period. This is another stock that I've used a number of times over the last few months. Very plus with patience, it'll usually provide some capital gain. Yeah, and that's kind of what I was. Thank you, Barry. When it comes to CTRA, that's kind of the advantage I think of sometimes recognizing these historical lows. And it's not only that the primary reason I like recognizing these lows is because that increases the odds that the value proposition is attractive. But literally speaking from a technical standpoint as well, these usually also start to increase the odds that you will see a swing back in the opposite direction. So we like to look at trends over time, and I am, as kind of a contrarian, I prefer working with stocks at the low end of their trading ranges in historical downward trends. and that's what CTRA has been following really since late March, and it's been consolidating for the last couple of months. So we'll see. Capital gains are always good. They're kind of a bonus. And if again, as Barry is saying, if you're working, this is one of the things I like about using this strategy in a tax qualified tax qualified account, I should say. It's talking about things like IRAs, Roth IRAs, those types of accounts. Is that things like capital gains, dividends, all of those things go in and they are allowed to grow. The taxes are deferred until you start to take distributions. And typically those distributions then are counted as ordinary income. So it simplifies the tax reporting for these things. So that's also attractive. Okay, let's take a look at Comcast then. On this one, remember I sold the 33.50 strike price. So here we are, and we can see with the stock here down a little bit below 32 right now. Very much down at the bottom end of its range. It appears to be holding pretty good support here around 31.50 roughly. And we had a really interesting pivot low in August that provided a little short-term bump all the way up here to 34, and it's using that level again right now. Now, whether or not this forms another pivot low remains to be seen. This doesn't count yet as a pivot low. This right now counts as stabilization, but that could be a temporary phenomenon. It is entirely possible that it could still break down below this support level, in which case this support would become new resistance. And then we would look for a new stabilization level, a new level of support at that stage. If it does, if this is a good solid sign of stabilization, a pivot high would be marked not only by upward movement today, but also by some additional movement to the upside in days to come. So a pivot low, I should say, is a clear V pattern where the stock comes down, stops, and reverses, very much like what we had here in August. Pivot high is exactly the opposite, where the V is inverted and you see the stock hitting resistance and dropping back down again. So just clarifying some of the terminology that you hear me use. Okay, so it's clearly below this price, the 33.50 that I sold. So let's take a look at it. Now this begs a couple of questions. I do expect to be, unless we suddenly see a lot of momentum through the rest of the day, and the stock somehow pushes above 33.50. I don't expect that. All things being equal, I expect to be assigned here. But here's something interesting. Here is that's the $31 contract. Excuse me. Here's 31.50 for today. This is interesting. Sorry, 33.50 is mine. Never mind. Okay, there we go. So remember, I brought in 65 cents on this one. This was my premium. Sorry, Barry, I do much better in my IRA because I use more sensible trades. In my personal account, I take some chances. Depending on how you have your buckets organized, that's certainly not a bad thing. And I kind of like the idea, to be honest, of organizing those buckets according to, say, tax deferred status or cash, right? A personal cash account, for example, maybe especially if that's a little bit smaller and represents money that, not saying it's not important, but that you feel you can be a little bit more aggressive with. That's not a bad way to kind of keep keep your buckets separated, right? I kind of like that. So I brought in 65 cents on this one, but if I wanted to avoid taking the assignment on Comcast here at 33.50, I could buy the stock back, or buy the option back, excuse me. But I'd have to pay about $1.87 in order to do that, which means that I would end up having to absorb a loss of, let's see, that would be about $1.22 per share. I sold one contract of Comcast, and so that means literally I would absorb a loss of $122. Now that may not sound too terrible, and I don't think it is. It's one of the reasons that I only sold one contract, is that I wanted to try to keep my position sizing very conservative, so that absorbing an assignment would only represent a small portion of the account. It also means that that if you're going to manage the trade more actively, absorbing this kind of a loss, it becomes a little bit easier. Truth is, if you are managing the trade more actively, the fact of the matter is that you were probably, you see bearish momentum here has been increasing for a couple of weeks, right? So literally speaking, you're probably not, if you're managing this trade actively, you're probably not in it still today. Probably and hopefully would have gotten out somewhere around here. My method here is to let the trade extend and go through expiration. The result is the result. I don't avoid put sale assignments even when bearish momentum is accelerating, like they are here in Comcast, for all the same reasons that we were just talking about for CTRA. These are stocks that I like, that I am willing to buy. It's why if you read my trading alerts, you'll see that I try to make sure to emphasize that I'm selling 33.50 in this case, because I think that represents a nice purchase price. So I'm not afraid of taking that assignment at that price. We'll see if the stock recovers or not. If it doesn't, it may mean holding on to it for a little while. But that's also the benefit of the system, is holding on to shares means that I get to go ahead and keep bringing in these dividends that are a little over 1% every quarter right now at the stock's current price. 33 cents is the next dividend distribution, and it looks like I'm gonna be on deck for that. The ex-dividend date is the 1st of August. And so unless the stock picks up a lot of momentum right between now and then, and I sell a covered call that expires before the 1st of August, it looks like I'm going to have an opportunity to bring in that dividend. So this is let's see, a little over 4% on an annualized basis right now at the stock's current price. So that's worthwhile. All right, Barry is not in CMCSA because he got out of it as of 9/5. So I went with a 3-week trade. You're in maybe if you placed it the same time I did, Barry, you're about a week. Had $32 put sale, brought in 58 cents, and have not re-entered. And so that's an example not only of working perhaps a little bit more quickly, which is a good thing, but also once it expired and the stock was up here, but picking up this bearish momentum that I'm talking about, that's recognizing that maybe that momentum is not something you want to sell into, and that's okay. That's okay. I like, under ideal circumstances, seeing stocks that are at their low, at the bottom of their historical ranges, but also starting to stabilize. In other words, we're starting to see some signs of consolidation around a certain price level. And right now, what's happening here is acceleration. I thought we were seeing some stabilization up here, which is where it was when I placed the trade. And clearly it's breaking down, but that's okay. Again, that doesn't really scare me too much. It may just mean that the consolidation range is extending between maybe 3150 and 34, about roughly. So, did your first pre-IPO investment with Angel Studios? Not great since it went public. We'll see how it turns out. All right. I can't speak too much to the fundamentals of the company. I am familiar with them since they are a company that does business right around where I live. But they are an interesting company for sure. Pretty strong downward move since they went public. So, but I have not analyzed their business. I can't speak to their fundamentals. And there's certainly not enough historical information here to try to arrive at any conclusion about value proposition relative to historical levels. That's one of the downsides of stocks that are brand new. So, okay. So that was CMCSA. That's Comcast. We'll see where this goes. Again, I'm going to just I plan to go ahead and take that assignment, and I'm okay with that. The next one is another put sale on Skyworks, and this is one I placed in the first week of this month using the 72.50 strike price and bringing in $1.70. So this is a stock at a higher strike price than Comcast. Still only sold one contract. So this required a larger capital reserve requirement just by virtue of the higher strike price that I was selling. So this requires a capital commitment with one contract of $7,250. If you're selling more than one contract, then you just simply multiply 7250 by the number of shares that are tied to the contracts you're selling. But let's take a look at where this one sits right now. All right, we're seeing some positive momentum in this case. The stock is it was showing pretty strong support around here at $72, which is around where about it was a little bit above this price when I sold my put sale, but looking at that as support, and so far that has held pretty strong with a nice, interesting liftoff the last couple of days. Even though today is a down day so far. Oops. Have a little bit of a downtick today. It is still above the midpoint of the prior day. And that can often imply, as we zoom in here, that midpoint is roughly about here. When we start to see stocks making larger than normal moves, and here's a little gap with a pretty large candle from yesterday's move. When we see these levels, the midpoints of these larger than normal candles become interesting levels of support or resistance, relatively speaking. Since the stock opened higher initially, this midpoint should act as near-term support. So far, looks like it may be getting ready to test it, but it hasn't broken it. So if that holds, that'll be interesting. Barry Angel, I'm sure a lot of the selling was getting out from the initial listing. Almost certainly, you get a lot of very quick profit takers. So, excuse me. Okay. So we'll see. Here it is testing. It's come down here, even just in the little bit of time that it took me to take my drink. So it is currently testing that level. So we'll see if it holds that or if it breaks down below. Lead plaintiff appointed in class action suited for Skyworks. So that could be having an impact. We'll see. We're seeing some bearish momentum on that. That could also just be a little bit of technical selling as the stock is coming up here to some of these previous pivot high levels. It could just simply be some profit taking as well. So we'll see if what this does. But so far, with my strike price all the way down here around 72.50, looks like I'm in a pretty good spot. Barry, maybe it'll be another Netflix. As far as Angel goes, very possible. I can't say for sure. I don't know, but they have an interesting model that they operate under in terms of the way that they finance films, and we'll see. You could end up laughing all the way to the bank over the rest of us. All right. Skyworks then, so it does look like this one is going to expire, which is for some an ideal result, and that's a good result for me. It does mean that once the trade settles again, that'll take, assuming the stock stays above 72.50 through the close of the market today. That does mean that the $7,250 I put on reserve will come back to me roughly Tuesday for to be available for the next trade. In the meantime, though, there can be and sometimes is an advantage in trying to manage the trade a little bit more actively. And with the stock up above the 72.50 strike that I've talked about, there is an opportunity to analyze this critically. Barry, they have a niche and you're a subscriber. Awesome. They do have a niche. I certainly don't disagree with that at all. Okay. So this is an interesting stock. The asking price here is, I would say, a little bit misleading, simply by the fact not only that there is no volume, but by the fact that the stock is, the option is set to expire today. So, everything is time decay is accelerating on a stock like this right now. And that's literally by the hour, since we have expiration coming up today. I'm more interested here in the previous close, which in the last trade was yesterday, just before, a little bit before the close, at around 15 cents. So that implies to me that if I wanted to buy this back and I were willing to wait a little bit, I could probably do that for 10 cents, 15 cents, whatever the number was. That could be interesting. Allow me to hang on to the lion's share of the $1.70 that I brought in premium. The other advantage that it would give me is that it would make that $7,250 in capital that I put on reserve available right away, instead of having to wait the normal 1 to 2 days, Monday, Tuesday, before I would be able to use that capital again. Uh, if I were able to place this before the market closes, say if I were able to do that right now, for example, uh, that would close out the obligation immediately, and the capital would then come back to the account and be available for the next trade. If I have an idea of what I want to do with that capital right now, that can be very useful. That means accelerating the number of trades that I'm able to place relative to what I usually do. This is more active than just simply waiting for the option to expire, which is what my normal method is. This is when I talk about accelerating trading frequency, this is how you do it. This would be buying an option back, either to limit loss, for example, in the case of Comcast, right? And maybe you want to avoid the assignment. Buying the option back does, in that case, would mean absorbing a loss, but it also frees up the balance of that capital minus the $122 that I would have had to absorb. So then I could go place another trade. Instead of having to wait for Monday, Tuesday, that money would be available now. If I bought Skyworks back now, the same principle would apply. That capital then becomes available to deploy elsewhere. Maybe I want to keep working with Skyworks, maybe I don't. I don't know yet. But that would be something that I could decide whether or not I wanted to do. In any event, increasing the number of trades also increases the opportunity to apply the compounding effect of income generation, of put selling, covered calls, all of these other trades to my account. And even if you're only doing that, it may not be on an individualized trade basis. You may be talking about a difference of a 0.5%. Um, Sometimes maybe not even that much on a net basis. But if you're repeating that over and over and over again over time, and you're taking advantage of those opportunities as they come, they're not going to come on every single trade, every single position that you work with, but they do happen frequently enough that if you are managing more actively, you will in all likelihood see much larger returns than I do on my trades. I refer to the way that I approach my income trades as kind of a passive approach. I set the trade, I let the result be the result. If I get assigned, I get assigned. If it expires worthless, it expires worthless. By actively waiting for expiration, that means that I'm not able to place trades with the same capital as frequently because I have to wait for that trade settlement to take place. If you're trading more actively, we're not talking about waiting necessarily to the day of expiration to make a decision. It's just that for Skyworks right now, that's where we are. This contract expires today, but let's face it, yesterday, possibly even as recently as a week ago, with the stock around 74, there may have been an opportunity there to uh, buy the option back, buy it to close, and at a fraction of the premium that was brought in, and then to turn around and then resell at a different price. So that becomes interesting at those stages. Now, in the case of Skyworks, if you were going to do that, the question then becomes, what would you do next? And so one of the things you have to decide is, do you want to work at a higher strike price? You almost certainly, in most cases, need to consider going further out in time. So if I'm going to work with Skyworks, since this one does not trade weekly options, the next available expiration is the October week 3. And with the stock up a little bit above 76 now, that means that 75 is the first out of the money contract, and that there is an interesting put sale right there. Again, this is 4 weeks out. But if I bought back the 72.50 that expires today, and then could turn around and could hang on to most of that premium, maybe $1.55 of it, and then turn around and sell the 75 for 4 more weeks and bring in 220. This is, let's see, the current trade on Skyworks. This was a 2-week trade. This one would be 4 weeks. This is, I'm talking about 6 weeks of time. Let's go to the calculator for a second. These are all theoretical numbers. Let's say I hung on to $1.55 of the premium that I brought in on the current put sale by buying it back. Then I turned around and I sold 220 at 75. So that's $3.75 in premium. Now, since I'm working at 2 different strike prices, I'd have to kind of split the difference between them. So 250, half is $1.25. So that would mean 74, 73, 75. So 375 in total premiums divided by 73.75 as in terms of a net cost if I were assigned on the $75 contract. 5.08% for 6 weeks. And if we want to just take that against the $75 contract, since that would be the new assignment price, still 5%. So, you know, that's for 6 weeks of time. Call that 50 days. That means 7 trades per year. So it's just applying that, you're that's a simple approach. You're still setting up an opportunity to possibly get up to 35, generate up to 35% return on your capital just by selling options. This is where a lot of people, when they ask what I do and how I trade, I tell them that I'm an option seller. They ask, well, how did you do on your last trade? Oh, about 1.5%. They scoff, they laugh, chuckle. Oh, really? Wow. What they don't realize is that when you set up these opportunities again and again and again, you get these opportunities to compound, to build one on top of the other. And that's why we work with very, very short-term expirations, and why I don't worry about trying to buy the market or even trying to keep up with the market. I'm not trying to beat it. I'm not trying to keep pace with it. I'm just trying to find functional trades. And these are more than functional. So, okay. So that is, that's Comcast. Close the book on that one. And then the next trade that is on deck is a covered call on Schlumberger. This is a stock I was assigned back here at the beginning of August at $35. And I had one other opportunity to sell a covered call at the end of August that expired, and then was able to do another one here. Nice little 9-day trade that I placed on the 10th, selling again the $36 strike price. Now, for energy stocks, don't seem to be enjoying the rally as much. Again, I was assigned at 35, and this one's a little bit below that now. Again, we're seeing some bearish momentum pick up here. Here's the price that I was assigned. We're down here a little bit above 39 right now. Gib, that's why I calculate all my trades based on an annual return. Yeah, and I agree with that. And you know, you do that enough, you start to kind of develop a shorthand, right? So I can look at one of these and I can see if I'm doing 1.5% in 2 weeks. Hey, that's actually, I'm getting up above 30% with that kind of result. So, I'm good. That's why I also set kind of just a minimum baseline. My target is on average 1.5% per month. On an annualized basis, that's only about 18%. But again, I'm just looking for functional. And so setting that 1 month baseline for me, it helps to keep it simple. So we'll see if Schlumberger, it does look like this covered call is also going to expire worthless. Again, that's not something that bothers me. I like getting called out of these covered call trades because that does obviously sell me out of the position, and does make the capital that I put into the trade available again. And with Schlumberger at 35, that's 100 shares, so that's $3,500. But I'm also okay on this one with having it expire. That doesn't hurt me at all. In fact, on this one, I qualified for this dividend 28.5 cents from the 3rd of September was the X date, and that's going to be paid out in October, which is more than fine. A little over 3% at the stock's current price, and that's fine. That's just additional income. In the meantime, my covered calls. This is where I talk about covered calls paying myself a dividend, right? Here's the first one. Excuse me, that's the second one. Here's the first one, 67 cents, 81 cents. And let's think about this for a second. 67 plus 0.81. It's $1.48 in premiums that I've generated from covered calls. I divide that by the $35 strike price that I own the stock at, and that's an additional 4.22% that I've been able to generate just since the last part of August. Now, if we add in that dividend, now we're a little over 5%. I'm good with that. That's just the net result so far. And so having the other thing that this does, besides generating a positive net return, is it allows me to put price movement in perspective. And what I mean by that is my purchase price is $35. That's the price that I was assigned at. But every time I generate income on these, every time I bring in a premium, every time I bring in a dividend, in terms of tax accounting, there's a term called cost basis that you have an opportunity to you can subtract these numbers. These premiums come in as a positive credit to your account. It means you can count them against the price that you paid to buy the stock. And here's why this perspective is interesting. Instead of thinking about them only as return, I can take that same, $1.48 plus 0.285. There we go. I can take that same $1.76. Oops. No, that's not negative. All right. I can count this against my $35 debit, right? This is a cost I had to pay. And that lowers my net cost to 33.23 and a half. Okay. So now this gives me a new baseline number to use as I'm analyzing price action. Now, this was the price that I was assigned at, but my actual net cost is down around here. All of a sudden, this changes the technical viewpoint of what I'm trying to do with my trade. And so this is the other reason that income generation is so useful, is it allows me to reframe risk and opportunity in really practical ways. This is a way to gives me a way to um, eliminate, not eliminate, but to minimize the subjectiveness that comes with trying to analyze stocks that you have open positions in. It's really easy to get wrapped up in price action and let that kind of swing your emotions. It's kind of, in fact, I'd say it's harder not to, right? Because as the stock swings back and forth, you get all kinds of things going. Am I going to be, am I going to lose money? Am I going to make money? Holy cow! Look at, if it's moving in my favor, how far is it going to go? All those kinds of emotions start to come to play. But when you're trying to be conservative, when you're trying to be disciplined and systematic, um, thinking about things like what your net cost is, and this is again one of the things I like about being a put seller and working on the selling side here, is I get to count all of these against my net cost, and that gives me the ability to think about things like, oh, my covered call just expired worthless, and the stock is now below the $35 strike I was assigned. Oh, is that a gut punch? Well, not really, because my actual cost is all the way down here. So I've actually got some room to think about, to not necessarily sit easy, but to breathe easier. Um, and this, in very literal terms, if I just want to talk about absolute break-even point, this is where that is right now. The stock can do whatever it wants between 33.23 and above, and I'm okay. And every time I generate a new covered call, every time I bring in a new dividend, that baseline starts to just kind of tick a little bit lower. And so it starts to set up a scenario where trade management becomes a lot easier. Being objective becomes a lot more practical. Okay, Barry, sorry for comparison. He has a 36.50 call, so a little bit higher strike price, expiring on 9/26. So you got a little bit longer to wait on that one, but same principle, right? By selling a little more time, I'm going to assume that you probably brought in a little bit higher premium. You also baked in potential for a little bit more capital gain on that one, Barry, and that's not bad. Okay, let's go ahead and let's just check in on the trade that is coming up for expiry on the 29th. So 10 days. All right. So this is Bristol Myers. And on this one, I sold the $46 strike price, bringing in 75 cents. Still a little bit of time to expiration on this one. And again, this is another one that's picking up some bearish momentum. We're at 45.53. Again, very low end of its trend right now, and pretty solid consolidation down in this lower end right now. Barry, you're in Schlumberger at 36. Okay. All right. So we'll see on this one. Right now it is a little bit below. Now this does set up, one of the things that I like about this one, since we do still have some time to expiration, this does give an opportunity to evaluate trade management from in a little bit of a different lens, right? Because with time still to expiration, okay, that was a typo. This is next week. It does not expire on the 29th. It expires on the 26th. Sorry about that, folks. Okay, so with a week out and a week still to expiration here, the stock is not so far below the strike price to really necessarily be problematic, but it does open up an opportunity to think about possibly buying the option back. So I'm working with the $46 strike. And again, I brought in 75 cents. And right now, the asking price on this one, here's 46. The asking price is 95 cents. So this one, if I wanted to try to limit any potential loss here, if I were concerned about this momentum starting to accelerate, and maybe especially if I am managing the position more actively, I'm seeing this, and I'm seeing the low end of support here is a little bit below 44, maybe even 43. Maybe that doesn't sound so great. And if it doesn't, that's okay, by the way. That does mean that if you want to trade it more actively, manage it more actively, absorbing a 20-cent per share loss, $20 in my case, since I only sold one contract, is not a terrible thing. That's loss minimization, right? And when you're trading more actively, and I'm not just talking about buying options and buying stocks for short-term purposes, but if you're using income generation and you're kind of using it as a way to apply some swing and momentum trading strategies, then you should be thinking about how to manage these more actively. And in that case, this 95-cent asking price may not be the worst thing, because you are going to take a higher number of losses when you trade more actively than what I do. That's not to say that it's more risky. It just means higher number of trades means more higher trading frequency means a higher mix of winning and losing trades. It's just a practical reality. The other part of that, though, is by limiting the loss moving on, which is what I do encourage if you want to be a more active trader, means that you also have you're hanging on to more of your capital than what I do, than what I have to think about when I'm managing a trade stock that is far below the strike price that I assigned, and I'm waiting for it to come back. So this may be effective, buying it back at that price. If you want to be more active in your trade management, that might be a good thing. It also would allow you to recenter and maybe think about whether or not, if I still like Bristol Myers, maybe I recenter, maybe I go down, maybe 44.50, 77 cents. It's not terrible. It's a little over 1.5% for 2 weeks. I don't know. That's not terrible. That's not a bad price for that one. Barry preempted me on BMY, and he's in it at 47, waiting for a call opportunity. Previously been in the 60s to 40s. So 40s look attractive. And that's kind of the same thing for me. The last time, it's been a little while since the last time I used Bristol Myers for any income trades, but it was in the 60s last time I did. So with it down here in the mid 40s. I like it. This is another attractive, another high value stock. So not afraid of this one. And even for all of the talk that I've just given you about the advantage of managing trades actively, that is if you are and minimizing loss. That is if you are specifically taking a more active approach than I am. I am very comfortable owning this stock at $46. That's why I'm willing to let this trade go ahead and cycle through and see what happens in the next week. Now that does mean it could be multiple dollars below 46 next week. We'll see what happens when we check in on it. But I'm okay with that. This is again a company that I like. At $46, it's a very high value, and if that means that I have to hold on to it for a little while, that's okay. It's a conservative position. I only sold one contract, so that's a $4,600 capital reserve requirement in my case. I can live with that, and that's really the big question when all is said and done. Make sure that for every trade that you're placing, that your position sizes are conservative enough that you can make a practical decision, objective decision about how you're going to manage the trade, whether you're going to trade it actively or whether you're going to do the same thing that I do. Barry, with the Intel gap up, he was able to write a $38 call yesterday for 75 cents, expiring the third week of October. Good job. Awesome. We'll see if that gap is able to hold. I was looking at that briefly before the live stream started, and that's a big gap, 25 all the way up to 30. NVIDIA gave them an infusion of cash. We'll see how that translates. So it is showing some bullish momentum right now. Barry, you're looking, $38. That's quite a bit away, right, from the stock's current price. With some time, you got about a month. We'll see if it can cover that distance in the next month. A little bit of a dice roll, right? See how it goes. All right, everybody. Thank you for your time. I really do appreciate your participation and your comments. I hope you have a wonderful weekend. It's fall and college football is rolling. Yeah, Barry, it is coming on the way back down. Hope everybody has an opportunity to enjoy some quality time with your loved ones. Hope you have a great weekend. If there are questions that come up between now and next week, don't hesitate to let me know. My email address is rebelincomesystem@gmail.com. You can email me there or reach out to me on Substack or Discord. Again, thanks. Appreciate your time. We'll talk again next time.